As the end of the year approaches, let's take a minute to reflect on everything the internet has given us during 2018. We've had terrible acting.
Our friends had been suggesting for a long time that we visit this wonderful town.
More terrible acting.
My administration has accomplished more than almost any administration in the history of our country.
And a reunion of 4 middle-aged mums who really should know better. But the internet has been particularly busy with one thing this year: grown men crying.
Nothing. We mean no ill will.
This month, a new member joined the viral blub club. This guy.
I am so sorry that I was unable to manage the rogue wave that hit us this week.
James Cordier is the boss of OptionSellers.com, a Florida-based hedge fund that's gone spectacularly bust, taking at least $150 million of its clients' money down with it. He was gaming the American energy markets until they went gaga earlier this month, with the kind of volatility that's been mainly unseen for years. As oil prices crashed and natural gas pogoed, Cordier's catastrophic bad calls wiped out his fund in just 3 days. And the worst part? His clients could now be liable for the additional leverage that the company took from its brokers in a desperate attempt to stay afloat. So not only have Cordier's clients lost everything they invested in his company, they may have to stump up even more as the disaster unfolds. That's like someone knocking down your house and then billing you for hiring the wrecking ball. Now this is big news because Cordier was the self-styled king of options trading. He'd even written a book about it called The Complete Guide to Option Selling. Surprisingly, there's no chapter on what to do when you appear to have literally ignored all of your own advice. Which explains why Cordier's more than a little teary in his apology video, warning it contains levels of cringe unseen since... Oh God, please, no, it's still too soon.
Good afternoon.
Here's how Cordier kicks off his apology.
Needless to say, the events of this past week have been incredibly devastating for...
For who, James?
Our clients.
There it is. Yes, your clients. You know, those people who've lost all the money they gave you.
For Larry and Rex, looks like I owe you a Cuban sandwich.
This is awkward, James, but you definitely owe them way more than that.
Troy, I was really hoping to become a boating enthusiast with you.
I think what all of these people would like is for you to just return their calls.
For a client in Marseille, my wife and I were certainly looking forward to joining you, the French Riviera. Sounded so beautiful.
Just stop talking, James. So how did Cordier come unstuck? It all comes down to the financial product that made his name, options. Of which, ironically, he doesn't have many left. Options trading involves buying or selling the right to buy or sell an asset at an agreed price, known as the strike price, by an agreed date. Options come in 2 forms: call options, which mean holders can buy the asset at the strike price, or put options, which means they can sell it for the same. Option traders, like Cordier, get paid a premium for every option they sell. For option buyers, making money all depends on what happens to the asset's price during the term of the agreement. Call option holders make money if it rises above the strike price, because they can buy it for less and then sell it on at the new higher price. Put option holders cash in the other way round. If the asset falls below the strike price, they can sell it for more than its value and keep the profit. All of which makes market volatility great for option holders, but really, really bad for option sellers. Because here's the critical difference between the two. Option sellers, like Cordier's firm, have to fulfill the deal if necessary. Option sellers need markets to stay relatively stable so that their agreements don't become profitable enough for buyers to trigger. The more the market moves away from the strike price, the bigger the risk. And what makes that risk even more dangerous? Selling naked, as it seems options king Cordier had been. Not literally naked, although that would explain why all the content on the OptionSellers.com website has been wiped. No, naked option selling involves trading calls and puts on assets you don't actually own, shorting them in the hope their price stays above or below the strike you've sold and allowing you to walk away unscathed with your premium. It's a strategy that's been known to net more than 75% returns on a monthly basis. But when it goes wrong, it can be catastrophic. Let's say an option seller called James sells a 3-month call option to, Irony Inc. to buy stock WTF at a $10 strike price. James agrees that strike price because he thinks WTF will stay below it for those 3 months, meaning the option will expire worthless and he'll walk away with his premium. Happy days. But if WTF suddenly rockets to $100 a share and Irony Inc. come calling, James, who's naked, remember, will have to buy the amount they've agreed at its current $100 value to sell on to Irony Inc. for just $10. Selling naked put options involves similarly rectum-shaking risk too. Now this time, Naked James has sold a put option to Irony Inc. for WTF at a $100 strike price, thinking it'll hold tight until 3 months have passed. But if WTF suddenly falls to $10, James now has to buy from Irony for $100, but can only sell on those piping hot turd Tatos for $10. Add a few $100 million to those amounts and you get an idea of just how quickly naked option selling can get really sticky. Especially when you factor in margins, which are fixed amounts agreed by option sellers and their brokers to cover potential losses, and are what Cordier's clients, already cleaned out by the fiasco, are now facing having to cover. There just wasn't any backup in case the proverbial shizer hit the fan. All in all, naked selling strategies like the one used by option sellers are a certain way to eventually blow up an account. We've had long periods of low volatility when outlooks like this can survive, but it's just like what Nassim Taleb refers to as picking up pennies in front of a steamroller. The smaller profits from premiums just aren't worth it when you eventually lose everything. Which brings us back to Cordier's client-facing mea culpa.
I promise you, every day when I woke up and I would check the markets, I was checking for rogue waves.
The thing is, James, you must have known the probabilities of what you were doing, but you got lured by the promise of a quick buck. Because financial history is littered with examples of unhedged short selling backfiring spectacularly. Because statistically, it's acknowledged as a high-risk play. And because you wrote an entire Forbes article in May about the volatility perils of the natural gas market, which is acknowledged across the financial industry as a widowmaker.
But our audiovisual guy always said to me to keep it short.
Oh, don't try and blame him, James. The important lesson from the option seller's fiasco is that there's no such thing as a free lunch in the financial markets. Always keep your risk in check with adequate hedging or other precautions as a number one priority.
And I'm sorry that this rogue wave capsized our boat.
I'll give it a rest, James. We've all had enough.